By mid-2026, institutional capital in the Indian equity market is actively splitting between two completely opposing trajectories. On one side, the traditional IT services sector is experiencing a historic contraction. The Nifty IT index plummeted nearly 25% in early 2026, forcing a hard reevaluation of the industry's terminal value. The root cause is quantifiable. Generative AI systematically automates lower-tier software tasks that generated massive billable hours, creating measurable revenue deflation. Meanwhile, real estate investment trusts, or REITs, are absorbing a sudden massive influx of passive institutional liquidity. This influx is the direct result of a legal reclassification by SEBI, which elevated REITs from alternative assets into the mainstream equity category. A historically premium tech sector is fighting technological disruption, while a historically illiquid real estate sector secures regulatory certainty. For portfolio managers, the immediate question is how to safely reallocate capital between these two opposing risk models. Mispricing this rotation exposes a portfolio to severe underperformance through the latter half of the decade. To map where the capital is actually going, we have to look at the specific mathematics of AI automation in the IT sector and weigh it against the mechanical rules of index construction in real estate. To see exactly how AI is compressing IT margins, we start with this chart representing the traditional IT firm's revenue pyramid. Historically, a typical firm's revenue splits cleanly down the middle, half dedicated to run work and half to change or transform projects. That 50% run segment consists of basic maintenance, software testing, and routine production support. Generative AI is highly effective at automating exactly this bottom-tier layer. As AI deployment scales, it actively replaces the junior, lower-cost roles that execute these repetitive tasks. IT companies are openly acknowledging the headwind. Earnings calls consistently point to an expected 2 to 4% annual revenue deflation, stemming directly from these AI-driven productivity gains. Over a 3 to 4 year period, this specific automation could dent overall traditional application and maintenance revenues by 10 to 12%. This direct top-line erosion feeds into a secondary pressure point, the compression of profit margins. Because AI disproportionately replaces the cheapest labor at the base of the pyramid, companies are forced to carry a structurally fatter, more expensive middle management layer. Average manpower costs go up, even as total headcount shrinks. Despite this structural degradation of their cost base, Indian IT companies are still trading at a valuation premium compared to US-listed peers, executing the exact same business model. AI efficiency represents a long-term shift in the IT cost base, altering the growth and margin assumptions that once supported these high valuation multiples. Defending current IT valuations requires looking past the immediate deflationary threat and focusing on the bull case for future volume. That bull case rests on a specific economic theory known as the Jevons paradox. William Stanley Jevons first articulated this in 1865. He observed that when steam engines became more efficient, England's total coal consumption actually soared rather than falling. The theory suggests that increasing the efficiency of a resource lowers its cost, which makes entirely new applications viable. We can map this directly to modern software engineering. Consider a digital transformation project that a corporation previously rejected because it cost $5 million. If AI development tools drop the cost of that exact same project to $2 million, the expected outcome is that the cheaper price tag makes it viable. Enterprise demand should theoretically expand, triggering a wave of net new project volume. The entire bull case for the IT sector hinges on this unproven hope. For valuations to hold, total demand expansion must arrive fast enough to offset the revenue deflation projected by the firms themselves. While IT services rely on theoretical volume models to justify their valuations, capital flowing into real estate is driven by hard regulatory certainty. In late 2025, SEBI amended its mutual fund regulations, officially reclassifying real estate investment trusts as standard equity-related instruments. It's important to note the boundaries of this ruling. Infrastructure investment trusts, or INVITEs, were explicitly excluded from this equity reclassification and remain categorized as hybrid instruments. To see the actual market structure, we can look at this methodology sheet for the Nifty REITs and INVITEs index. Inclusion is determined primarily by free float market capitalization. Because of this weighting methodology, the index features heavy sector concentration. Realty assets dominate the space, making up nearly 70%. When REITs are officially added to major equity indices, these passive funds are mathematically forced to buy REIT units to maintain portfolio replication. This creates a mechanical influx of capital, driving secondary market liquidity. This forced buying mechanism stands in direct contrast to the IT sector. IT needs a speculative surge in corporate spending to survive, whereas REITs simply need the calendar to hit September. This index inclusion solves the exact liquidity problem that kept large institutional money on the sidelines for the past decade. Index inclusion operates as a blind, mechanical force, shifting the capital flow from a matter of active investor sentiment to a function of index methodology. Institutional capital allocators face a clear choice: hold on to IT assets facing quantifiable disruption risks, or rotate into the newly accessible, highly liquid yields of real estate trusts. As a direct result of these conflicting forces, the traditional IT services sector remains structurally trapped in a persistent state of market limbo. For IT to recover its footing, valuations must compress to accurately reflect the AI deflation risk, or tangible corporate spending data must finally support the Jevons paradox theory. Real estate offers a stark alternative, anchored in physical reality and predictable cash flows. With regulatory hurdles cleared, impending institutional participation provides REITs with a permanent visibility upgrade and a massive liquidity backstop. The capital rotation of 2026 is defined by this exact trade-off. Smart capital is actively rotating out of the unproven, deflationary models of AI-disrupted tech and into the mechanical certainty of index-driven yield.